Welcome to Salty Investors, episode number 12. My name's Scott, and the bloke down there is Tim. How are you this week, Tim?
A bit cooler than normal for a 1st of December. But how about
Yeah,
yourself?
weird, isn't it? Yeah,
Yeah.
I had a blanket on last night in the 1st of December, which, if you're not from the Southern Hemisphere, is a bit weird, unless you live in Tasmania. This week, my salt is Phil from the RBA apologising to Australians if they were misled by his comments starting in 2020 about it being very unlikely that they would raise interest rates until 2024. Apparently, some Australians took him at his word, went out and bought houses for 6, 7, 8 times their household income. And now with interest rates on their variable rate mortgages at 6 and 7%, they're starting to feel some pain. So I don't think Phil should have apologised. But, it's a bit of a conundrum because in this country, we don't have much in the way of financial literacy. Now, what Phil should have come out and said is that I don't know why anyone in Australia took what we said as any kind of accurate forecasting guide, because we've never been very good at forecasting. And by the way, this admission means that I'm the most overpaid person in Australia. It's not really the Reserve Bank's job, I don't think, to forecast the economy, but most people don't understand that no one's very good at doing that, so they sort of put their trust in them. But they shouldn't. And a little bit of financial literacy and historical knowledge of the RBA's ability to forecast economic trends wouldn't go astray. So, I don't think Phil should have apologised, but he should probably come out and be honest and say, look, we've really got no idea when it comes to forecasting, so you shouldn't listen to a word we say. What do you reckon?
It's a safe way to go, I think. I think they're admitting that now as well. So,
Yeah.
I think they don't know where it's going to go. So even the Fed's saying similar things now. So I think a bit of honesty, wouldn't go
Yeah.
astray here. So
The problem is if you are too honest, which I don't think there is such a thing as being too honest, but if you are too honest, it's kind of just destroys the illusion that these guys are in control to some extent, which of course they are. So I just think too much honesty people would start going, well, what are you there for then? Why are we paying you $1 million a year, Phil? Yeah.
Well,
But,
I've said that a long time ago, so I'm over that illusion already, that these people can really control the economy and, they should be doing it. I think that, they shouldn't be doing it. So I don't know why people just want these fairy tales of, somebody who can, get us out of hard times and, blow up bubbles more than they should be and then, then complain about the RBA lifting rates to get us out of the trouble that they've caused. So I don't know.
Yeah. Well, we've become accustomed to it, haven't we? We've become accustomed to the idea that the government can fix our lives. And some people think that's a permanent state of affairs, when if they, again, had a bit of historical knowledge, they'd probably realise the government is often more of a hindrance than it is a help. Anyway, that's enough of that salt. What's your salt this week?
Well, it might sound a bit weird, but I'm actually a little bit salty for Tesla shareholders. At the moment, Musk is spending all his time at Twitter. Now he's starting fights with Apple, and I'm just a bit worried for the old Tesla holder here. Things are going to get a little bit nasty for him. Rates are going up. I haven't heard anybody that said, "Oh, we're going to have a 4 handle on next year." No one thinks that. Everyone's thinking it's going to be a 5. Some are even saying something else. So, and Tesla, how they get a lot of their profits is basically, finance. They finance a lot of these deals, and then, when you get people who can't afford the finance, they start selling secondhand Teslas. That's going to take away some of their, new car sales. So,
Yep.
And then you've got an environment where people thinking, oh, maybe a $70,000 car isn't so affordable. So I'd rather, yeah.
A $70,000 car's already not particularly affordable, even with the financing for most people, is it?
Yeah, so I'm just like, I'd rather, if I was a Tesla bag holder, I need the CEO on ship here, and
Mm.
trying to guide us through here a little bit. And, what's going to bring in earnings next year, I'd be a bit worried. And
Yeah.
the shorts are coming out like nothing now. Like they're saying, oh, $400, I'm back in. I'm shorting it at 400. But at 800, they were getting blown out of the water. So I don't know. It
Yeah.
seems like it's going to be an interesting year next year for them. So what do you think?
Yeah, well, I don't think Musk is going to stay at Twitter that long. I think he'll appoint a CEO eventually, and if he can find someone that'll sort of see things his way, be more even-handed, not so censorious. I mean, I did see some headline this morning about the trust and safety head honcho at Twitter, who was fired, is now sort of having a go at Musk, which is funny because it, from what we've learnt in recent days, a lot of pedophilia stuff was allowed on Twitter, or just was not censored. But if you misgendered a trans person who just changed their mind 5 minutes ago, you would get banned off Twitter for that. So it's a matter of priorities there, I think. And just weird stuff. But yeah, I think Musk will probably appoint a CEO sometime early next year, and yeah, he won't have to divide his time so much.
Yeah, but they're saddled with a whole of your debt at Twitter as well. Like, it's not going to be an easy job for the CEO. Imagine that. Like, you're
No,
trying to get revenue from, hopefully advertising's still going to be there, but, everyone's going to be not advertising as much. And then, you got all this debt that you got to service as well with increasing rates.
yeah,
Boy, that's going to be a hell of a CEO to take on this. So, well, good luck to him.
Well, yeah. I did hear something about a revenue sharing model, like similar to YouTube, that people who got a lot of following, got a lot of tweets and views and likes and all that sort of stuff, that they'd bring in something. That was an idea. I don't know if that would work. Don't know how it would work, but maybe who knows. Yeah, I guess we'll see. But yeah, I don't think he's going to stay there too long, to be honest. It is a distraction. I think Tesla shareholders should be rightly worried. But I mean, look, okay, he's been running Tesla for whatever it is now, 10 or 12 years. What else has he had been going on in the background? SpaceX, the Boring Company, Hyperloop. I mean, the guy is a walking distraction. That's what he does.
Yeah, but a low interest rate environment, you can get away with a certain amount of crap. Your capital allocation doesn't have to be top notch, because there's money coming in everywhere.
Yep.
But as soon as interest rates go up a bit, people go, oh, what could I'd rather just put in a T-bill here, and get a few, like, why would you take this extra risk? I don't know. I'd be a bit worried, that's all. So. Oh, I don't hold Tesla, if anybody's like thinking that I'm thinking for myself here. No, but, I just know a lot of people who do, they're bought into this hype and it could look ugly, that's all. So, yeah.
Yeah, well, I mean, it's been one of the most overvalued stocks for a long time, and it's just sort of come back down probably to where it should be, or even not even it's not even there yet.
No.
So yeah. Anyway, let's move on to the very invigorating macro discussion here that we always have. We've got some wonderful new data out, particularly in Australia. So CPI came in at a lower than expected 6.9% headline, lower than expected trimmed mean. For those of you overseas, that's basically our core, if you like, CPI. Now, of course, this actually, the Australian market didn't really react to this very much. It was a pretty sort of ho-hum day. Because remember, we were told, I think the RBA told us that we were going to get an 8 handle on our inflation at some point. And that's, I think, what I wanted to highlight with the next couple of charts was that can still happen. Phil Lowe was warning, given that we've opened the immigration floodgates, we've already got an extremely tight rental market. So that's obviously going to just make it worse, particularly in capital cities. So this bit up here is from Macro Business, and they said, so the ABS recorded 2.8% rental growth in the year to September, which is not that high, and that's because the ABS measures rents across the market, whereas all the people like CoreLogic, they have a look at newly signed rents in the area. And so the RBA, like the rental component, the owner's equivalent rent component of inflation in the US, is lagging, and that has some catch up to do. So, CoreLogic is saying rental growth's up 10% in the year to October. Right?
Wow.
Yeah. The RBA, the ABS is saying 2.8 to the end of September. So, and if you've been looking at rents where you live, I can't imagine that you haven't noticed. I think the Gold Coast is one of the biggest increases in the country. Brisbane has risen more than any other capital city, I think.
Well, you see Byron Bay, the people in, there's a lot of poor people in Byron Bay. Like, it's not a totally affluent area. And then you've got, so you've got this huge dichotomy of people, and the poor end of town is just getting annihilated. Like, absolutely disgusting what's happening down there. And then the council, obviously, just adding fuel to the fire on there, not allowing anything to be developed. So you've got a lot of people, young families living in cars, and it's disgraceful. But
so you look at that there. CoreLogic says Brisbane's up 13.5% in rents. Regional Queensland is the only regional in any of the states that's double digits. It's up 12%. So Queensland's copying. And the other thing is, so this is macro business again, and this is taken from Westpac, that if there hadn't been rebates offered in some of the states for electricity bills, electricity prices would have risen by 15% in Q3 rather than the 3.6% recorded. So again, inflation it depends what state you're in, because I don't think New South Wales and Victoria had rebates the last quarter. Your inflation rate could be 10+%. If you moved recently to another rental, and the rising cost of electricity, your inflation may have been 15% from a year ago. Could have been as high as that. So it's I guess, to come back to the original point, which was that that inflation rate of 6.9% is probably somewhat understated, and the pressures on rents and electricity prices aren't going away next year at all. If anything, probably getting worse. So the idea that that inflation is just going to run off next year and we're going to get back to a nice 2 or 3%, I think is a little bit far-fetched. What do you reckon, Tim?
Well, the thing that disgusts me is, like, a lot of this stuff you can't escape. Food, housing, like, you can't, not eat, and your clothing, you can slow down that a little bit, and your transport, you can just not go out as much. But the essentials of electricity, you can't just not have the lights on. Crikey, like, I don't know. It just doesn't seem something that you can just avoid and then, decrease your bills a little bit here. So
yeah, and especially hits the poor, because the poor spend the vast majority of their money on food, shelter, electricity. That's it's most of it for them. The people that live week for week, it's pretty much all of it.
Fixed income people, like people on pensions and stuff, like, if they're getting hit by a 10 handle here, and CPI is catching up with that, and most of their pension goes towards food and electricity and fuel and things like that.
Yeah,
very nasty. So
so I don't think the end of inflation is maybe overstated. As I said, maybe the market did see through that because it didn't really react that much. But in the US, just last night, the market did react pretty excitedly. It was up over 700. The Dow was up over 700 points. I think the S&P was up 100 or so. And that's because Powell signaled smaller interest rate hikes ahead, which actually I've said on this podcast for months. I think the next rate rise will be 50, not 75. And maybe they finish up at 4.75. Not, maybe they don't even get to 5. So I think Powell is now having sort of a split personality problem where he has to, he's admitting, we have to slow the rate of increases, that time is coming, but he also needs to keep the tough talk going, and of course the markets aren't that stupid. They'll see through that. But again, so they'll slow the increases, but the question is really how quickly does it come down the other side? Are we going to start cutting? And he's sort of making it clear that that's not on the agenda yet, cutting rates. But yeah, so that's old JJ. He's probably not the second coming of Volcker, as a lot of people predicted. He's going to fold up the tent sometime soon. So I think they've got a meeting next month, or it's this month, sorry, because it is the 1st of December. And then I don't think they have one in January. So maybe if he goes 50 in this month, and he's got a couple of months to sit on his hands and see what happens. See if he can get a 6 handle on inflation.
I've got one to throw at you. What happens if inflation comes a little bit hotter with the FOMC, the meeting beforehand? The market isn't expecting, everyone expects 50 here. Inflation comes in a little bit hotter, everyone will panic. And the VIX will, like it's in the low 20s at the moment, it'll jump above 30 because everyone will go, well, is Powell going to do a 75 again? Like, is he going to have to? That's it. Like, that's probably a 1% chance, but there's certain things here that nothing's, he hasn't got a crystal ball here. He only gets the data one day beforehand, before everyone else. So,
I just warn people against, because how our brains work is we think these things go in a linear fashion. There's no guarantee that you don't get just a spike up for a couple of months. It doesn't have to just all come down in a nice linear fashion. So that stuff can happen, and markets will overreact to that stuff. It's worth thinking about. Present opportunities.
Well, I'm hopeful that something like that, because I want to buy, but no one's pricing that in. Everyone, the narrative is taking control here pretty heavy. So
so that will lead us on to, I thought this was interesting because this chart was interesting because, as we know, and we've been saying this, that the slowdown, to the extent that there is any, is not being driven by the consumer, because the consumer had, especially this is the US consumer, they had all kinds of stimulus thrown at them, and they had record levels of savings. That this chart suggesting that excess of real disposable income is now gone. It's now back to trend. So that doesn't mean that consumers in trouble. They're just back to where they would have been without this massive stimulus. Excess. So the excess is now zero. So what you would expect to see is in the coming months into next year is probably more of a heavy reliance on credit cards and other things, which is already starting to show up in the data as well. So that's one more shoe to watch.
Well, maybe drop. The Black Friday sales have been pretty strong, and everyone's go, well, no one's got the money, so obviously that's credit card. And then you're thinking, that comes due, March, next year, so that compounds, and that makes it harder for a market to rally, a retail rally. So, I don't know, earnings.
There was a story out in Australia saying that the retail industry expects a really strong Christmas. A lot of the retailers are as well, but I think we're going to have the same problem. The hangover is going to be pretty bad for that one. As we said, the cost of rents and electricity and things, that's not going away early next year. So we shall see. And this last one, again, been harping on this for a long time. So this chart shows the drawdowns to be consistent with the recession, basically, earnings have to come down. If there's a recession coming, then you would expect operating earnings, the trailing 12 months operating earnings, to come down, and that's just, you can see the small line right at the end of the chart there. It just hasn't very much yet. So that just lends credence to the case that I think, as we said last week, Morgan Stanley is 20% below the market. I think they're at $195 for S&P earnings, and the market is currently about 230, 225, 230. And yeah, that just hasn't kicked in yet. It again, though, I guess you and I are unapologetically hoping for a downdraft early next year or something, to set up a better opportunity set. But even if earnings do come off significantly, there's no guarantee that the market necessarily has to sell off, because it may look out to the future and say, oh, well, inflation's coming down, so one offsets the other. That's always a tough call.
But if the Fed stays the course, they just stay steady, even if they don't hike or drop, they just keep it at the 5 or 4.5, whatever you want to sit at, and then people start thinking, well, you start discounting earnings on top of that.
Yeah.
Like, wow, that's when you might get an opportunity. But yeah, it hasn't happened yet. So, but it's just weird how the bond market's priced it in, that there's going to be a recession, and you still look at earnings and you're like, oh, it's not happening. So who's right here? Is the bond market right, or the equity market right here?
Well, here's what we know about earnings at turning points, is that the analysts are always late. They're always late. And that goes both ways. So they're always late to upgrade when you're coming out, and they're always late to downgrade when you're going in. So my money would be on the bond market is more correct than the analysts. That's my view. I mean, I think someone put out the other day that the S&P is trading on about 21 times trailing 12-month earnings, right?
Okay.
That's not cheap in anyone's language, and especially in an interest rate environment where it's going to be 4.5 plus for the next 6 months, easy. Interesting.
I haven't heard anyone saying 4. Everyone's saying it's going to get to a 5 somewhere along next year, but I don't know.
Yep. But the market will try to anticipate, and I'm hoping they anticipate wrong. Currently. Yeah. All right. This is a chart that you put in. What are we looking at here, Tim?
Yeah, like everyone compares us to the 1970s, but there's a more recent one where we had this huge hike. As you can see, when the Fed hiked in the 90s here, very aggressively as well. Like you can see here, like it very quickly went up to, over 6. So it's very similar to what we got now. And you can see in Canada, they did a similar type thing, and things didn't really change until, it started to get to that 6 number. So, but then you can see we've got a couple of quarters where it really, started to hurt. And and Canada, I've got here, is a equivalent to Australia, a commodity type economy, and you can see how much they hurt. Like they really, once the global economy started to slow down. So I think, he's pretty safe at the moment when you look at this. If you start to correlate these two, like we're at the 4, 3.75 to 4. So, still went up in a couple of big notches there. So I think, I'm not so surprised that next year, things might, and you can see where they just went sideways there for a bit, and the market didn't like it. Like it just really collapsed them there. You can see people just lost patience there.
Yeah, well, fortunately, what happens after that graph ends there is very interesting, because of course you have LTCM in 97, long-term capital management meltdown, and then this is when Greenspan starts really putting his thumb on the scale, and they start getting used to the Fed put doesn't it?
Mm-hmm.
That helped drive the .com boom, which really only took off in 97, 98, 99. Got absolutely stupid.
Yeah.
Yeah. So, but my view still is that if there's a little bit of pain, they will, they'll revert to type. I don't have any faith in Powell as the new Paul Volcker, and Phil Lowe is definitely not a Paul Volcker. So,
Yeah, so you're definitely in
yeah.
the bond crowd here, you know. Well, you look how inverted it is. It's still crazily inverted, you know. Like the 10-year 2 to 10 is just insane. Like, but you don't hear anyone talking about it anymore. That's just common,
Mm.
you know, every day. You know, everyone's used to it now. But I remember
Yeah.
a year or two ago, everyone was complaining about it. You know, oh, this leads to recession. But I look at it all the time, thinking it's just sitting there looking at us, you know.
Yep. Yep.
Mm.
Yeah. Um, all right. We are going to finish off with Moon. Now, what does Moon do, Tim?
Well, I don't know if you've got any Christmas cards this year or birthday cards. So what this company does is they basically online, so you can upload photos or whatever, and they print on demand basically, and they do digital cards as well. So very
Actually,
asset light.
I think I used these
Oh, really?
once to send a digital card. Yeah.
Okay.
Um, yeah,
Ha-
some years ago. Yeah.
Did it cost a couple of bucks
I
or
think it was free. I thought it was
free?
free. I thought I sent a free one. Yeah.
Okay. Oh,
Pretty
so they
sure.
must have promotions and whatever, but
Yeah.
yeah. But you can imagine a model where, you know, it's print on demand, so you're not actually holding the stock and you're
Yeah.
printing as used. And you can imagine all the APIs in the background. So programmers, like if you've got someone on your database that's, you know, you sold over $1,000 worth of stock to them a year, you could
Mm.
punch them through something like this, do a
Yep.
customized card to them, and it automatically gets sent to them. Really easy to use. And you can see this is one of these IPO things that's imploded 60%, as you can see here from the price to free cash flow. You know, things are falling off the cliff here.
Well, look at the PE. It's gone from 71 to 17.
Yeah,
So,
yeah. So intense value, but you look at here at these return on invested capitals. You know, like you're still, you know, that's a
yeah.
quality company. You know that it's not doesn't really need to invest much, and you can
Yep.
they can add more designs and things like that. That's not going to cost them any more, and they just pay a designer a per fee for a card.
Yep.
Um, So, and then they've got all this data as well. So if you sent a card to somebody, next year they go, hey, you know, last year you sent a birthday card to Joe Bloggs. Would you like to send him another card? And would you like to add a gift to that? You know, so it's got a bit of a value add type component to it as well. I'm just not sure
Right.
people will take on this type of the newer generation. Like, it's just, you know, card giving going to continue.
Do you know the breakdown between what proportion are digital and what proportion are actual physical cards?
I don't know, but I think. But the good thing about the digital ones is, well, you can personalize them. But
Right.
do the younger generation actually give a crap about all this, you know, cards and, you know, all this sort of stuff? I don't know. Have you got many Christmas cards this year, or have you, you know, has that thing slowed down, or your parents have
Yeah, I
they
mean,
got them, or do they do that, or still? Or...
well, they haven't got any yet. I think maybe it's still a little bit early for that. They probably start getting them this month, right?
Yep.
I see. I don't think like I'm a Gen Xer, and I don't think we really do that
No. Yes.
anymore, do we? I mean, yeah, I think that's something that probably it's an older generation thing. That's why
Mm-hmm.
I would suspect that people would send digital cards to one another because it's just so much easier. There's no postage involved. There's no envelopes or any of that sort of shit.
Yep.
You don't have to go to a post office. Yeah.
ESG friendly. You know, you're looking for any.
Yep.
You know what I mean? Like low cost. You know. But yeah, like, or do people just say happy birthday on your Facebook profile? You know, that just
Yeah.
seems to be, I just don't know. I just can't see, I can't look through 5 years. Even though numbers look brilliant,
Yeah.
I'm just worried that it's more of a boomer generation type
What sort of
benefit.
so what I mean the barriers to entry to this wouldn't appear to be particularly high either, would it? I mean, what's to stop a competitor coming in offering same
Well, there
price?
has got, the problem is there is a little bit of barriers to entry. Like, it's their database is the cool thing. So when
Right.
you send a card to somebody, especially a digital one, it's got from Moonpig. You know, Moonpig has
Yeah.
sent you a card and saying, "Oh,
Yeah.
that's a pretty good idea. I might do that myself." You know, instead of physical cards or whatever. Um, yeah, I just don't know. You know, I'm just not sure. You know, as you can see, from 2000, it's been running, so it's
Yeah.
around for a long time. And yeah, I just, a couple of people are looking at it. I just, you know, you're just looking at these return on invested capital numbers, and you think,
Yeah.
crikey, like, if it continues on for another 10 years, this will be, you know, a gold mine. But the barriers to entry
Yeah.
are fairly low. Like, and I've been
Yeah.
burnt on this before. Redbubble and, you know, all these print
Mhm.
your own shirts, and Amazon
Yep.
do it, and
Yeah.
so the barrier to entry actually isn't super high. But if you've got somebody already doing it in this market, you'd have to, you know, you'd have to compete against that database and undercut them. Yeah,
Yeah, well, so here's something. I don't know if this is relevant, but when I started my business 3 years ago, I got some T-shirts printed up, and I went through one of those online stores, and you send them your logo, and you choose the shirt you want, and they
okay.
stick, here I want the logo here, and that's about it. You can get all kind of features, but so I did that, and it cost, I don't know, $50 a shirt or something like that. It's a decent shirt, collared shirt. Um, I went to get some hats done, and they were just they just seemed a bit ridiculous, like $30 a hat, and I just thought, oh, that's a bit. I went to a local on the Gold Coast, a local sort of business that does workwear, high vis stuff,
Yep.
boots, the whole 9 yards, and they did it for me for about, I think it was about $9 a cap, the same thing. And so the whole idea that the online store has far less overheads because they don't have physical stores, and they can just the pricing was night and day. So the local store, the physical store, actually did it a lot cheaper. They couldn't match the price, the online store. So yeah, maybe the returns to that's just gone away. I don't know. Maybe, I mean, more broadly, I know this might not sound relevant, but what about the returns to streaming? That's all become compressed now, right? Remember
Yes.
the promise? I was thinking about this the other day. There used to be a video store. It closed down about 4 years ago in the little strip mall near my place. Now, you used to be able to rent a new release DVD, sorry, for $3.
Wow.
Now, if you want a new release on
Oh,
any of
yeah.
these streaming platforms, it's like $15 or something.
I
So
know.
like, but I guess that's just the price people are willing to pay to not have to go anywhere.
Yeah.
But again, the returns are compressed, and maybe all that. Maybe there's not much left in some of these businesses.
Well, all these streaming places are competing very heavily against each other now. You know, like
Yeah,
Disney and, Paramount, and, all these other. I see AMC. They're going to the wall now because they're trying to do all this streaming, and it's just not free to set up all this stuff. You need servers, and you need infrastructure, and then you need subscribers and no churn and economies of
yeah. Well, look how
scale.
much Disney
Yeah,
Disney's spent on
yeah,
content.
yeah. So I don't know. Like, and you can go buy a card from a cheap store, a dollar store for $1. Like,
Yeah,
and then you go, no, I'm going to buy a card here for $5. I know you can post it to them, blah blah blah, and you don't have to get off your chair, but
mm.
I just don't know how much value is going to be here long term. But you're seeing all these things pop up now. The collapse of the SPAC type,
Yeah,
IPO type world, and you're thinking, oh, like there's a couple in Zoom, as well. Like, that's all. The numbers look great on that as well. So, yeah, just keep my eye open.
yep. All right. Well, we might leave it there with Moonpig for this week. Thanks everyone for joining us, and we will catch you next time.